Thank you for joining us for this episode of Comply on the Fly with M3 and Karen B. Comply on the Fly is your trusted weekly resource for reliable insight and quick answers on common employee benefits compliance questions. Please note, this podcast and the contents herein do not constitute legal advice. Seek the advice of counsel for any employee benefits compliance-related guidance or strategy.
Hello, everyone. I'm Karen B., and the Comply on the Fly question of the week is, well, it actually is a compilation of questions that I've received since the IRS, Internal Revenue Service, issued the newest affordability percentage that we informed you about over the last few weeks. The question is whether or not, after doing the calculation for 2024, you are required as an ALE or applicable large employer to make the coverage affordable for all full-time employees. Of course, affordability may get challenging with your lower paid employees that you may not consider full-time, but the ACA does because they work 30 or more hours per week. Under the employer shared responsibility rules, you are required to make an offer of affordable, valuable coverage to all of your 30-plus hour employees or face penalties. Most employers will at least manage to the offer of coverage, but where you might need to make some business decisions is on the affordability piece. And remember, it not only has to be affordable, but also valuable. The value of your plan is usually the easy part. Unless you have a really high deductible plan, most plans are valuable. But if you are concerned, your M3 account team can provide you a link to a minimum value calculator. But assuming your lowest cost single coverage plan is valuable, you will have to turn your attention to affordability. And affordability is based on either the federal poverty level safe harbor or is dependent on your employee wages and is calculated, of course, using that percentage issued each year by the IRS. For 2024, this percentage is the lowest it has ever been at 8.39%. So while you may have only needed to make minor adjustments to premium splits in the past to remain affordable, this year you may have some decisions to make. The first thing would be, again, to look at the affordability calculations. If you do not have an employee premium contribution of less than $101.94 for 2024, then you would not be meeting the federal poverty level safe harbor for affordability. So we suggest that you next move on to the rate of pay safe harbor. For this one, most employers will take the lowest rate of pay paid to a 30 or more hour employee and use that as a threshold. Say that you have a 30-hour employee that is paid at a rate of $14 an hour. The calculation for 2024 would be $14 an hour times 130, which is a constant, which comes out to $1,820 of assumed monthly income, which you then multiply by the 8.39% to arrive at $152.70. This would be the maximum amount you could charge a full-time employee paid at the rate of $14 an hour to be affordable. But let's say that your lowest cost single coverage premium contribution has been set for 2024, and it's $198 a month. Well, we would have to do some more math to determine at what rate of pay the premium would be considered affordable. Now, math was never my strong suit, but here is what you need to do to back into the affordable pay rate. If your premium is $198 per month, you would divide that by 8.39% to determine the monthly salary rate, which is $2,359.95. Then, to determine the hourly rate, you would divide by 130, which comes out to $18.15 per hour. Doing this math will help in determining how many people are receiving unaffordable offers of coverage if you do not change either the premium rate or an individual's hourly rate. So let's say you have 25 individuals making between $14 an hour, which is your lowest paid full-time employee, and $18.15 an hour, which is where we determine the $198 per month is affordable. Those individuals are essentially your penalty exposure. And what is the exposure? The annual penalty for an unaffordable offer of coverage in 2024 is $4,460, and that's annual. Remember, this is penalty B, or the unaffordability penalty, not the sledgehammer penalty that applies to not offering coverage to at least 95% of your full time employees. Penalty B applies on an individual basis to those you did not offer affordable coverage to, but it requires enrollment in the marketplace and receipt of a subsidy for those individuals. So, worst case scenario would be that for all 12 months in 2024, all 25 individuals were enrolled in marketplace coverage and received a subsidy. Your maximum exposure in that situation is $111,500. But not all of those 25 will go to the marketplace. Maybe they will, but some will enroll in your coverage. Some will be on the parent or spouse's plan. Some will not have coverage at all. But the maximum exposure calculation will help you determine what changes you want to make, if any, and what penalty risks you are willing to take on as a business. So, when looking to 2024 and your premium contributions, this is something important to keep in mind. And that is your Comply on the Fly question of the week. Thanks for tuning in.
What's on your mind? If you have a pressing compliance question, send it to askkarenb@m3ins.com. We'll do our best to cover it in an upcoming episode. You can now follow and subscribe to Comply on the Fly on Spotify, iTunes, and Google Podcasts. Make sure to tune in next week and encourage others to join us.